Hey everybody, I've talked quite a bit about ETFs this year, so I wanted to go ahead and consolidate all my ETF ideas into my five top ideas for the year. Before we get into it, please take a minute, click subscribe to my channel if you don't already, and check out the link you see on your screen. You can get a message from my sponsor, The Motley Fool. It's the best way to support this work I'm doing on YouTube. All right, so let's get right into it. The first ETF I am very bullish on in 2024 is the Vanguard Russell 2000 ETF. I recently wrote an article about how small cap valuations are at the lowest valuations relative to large caps for, since the 90s. It's over 25 years since we've seen this kind of valuation gap. So the Vanguard Russell 2000, ticker symbol VTWO, not a high yielding ETF, but you wouldn't expect that from a small cap index. The Russell 2000, if you're not familiar, is considered like the small cap benchmark index. It's a very broad index of smaller companies, and in addition to that valuation disconnect, which last time, by the way, this valuation disconnect was so pronounced, we saw 12 years of outperformance of small caps. Small caps could also be a big beneficiary as rates fall, which are widely expected to happen in 2024. Just to name one thing, small caps tend to have greater leverage than large caps, just as a whole. So that could be a positive catalyst as borrowing rates come down. There are a few other reasons as well. For example, right now there's a lot of money sitting on the sidelines because people are happy to get 5% yields from CDs and savings accounts and things like that and treasuries. Um, but as rates come down, appetite for risk will come up because people will want higher yields than those instruments are paying. And generally, when money comes back into the market, it favors more speculative assets, which small caps as a whole are considered to be generally more speculative in younger companies than large caps. Now, this isn't universally true. There are some very mature small cap companies, but remember, this is an index of 2,000 companies, so we kind of have to look at it as a whole. Number two, and a lot of the same reasons here, the Vanguard Real Estate ETF ticker symbol is VNQ. It has a much higher dividend yield, so it could be a better choice for income investors. Has about a 4.1% yield right now. And as the name implies, it invests in an index of real estate investment trusts. Like most ETFs, it is a weighted index, which means larger companies make up a higher percentage of assets. And right now, there's a few reasons I like this. Real estate has been one of the worst performing sectors over the past year, year and a half, because they are generally very interest rate sensitive. These are income focused investments. When you can get 5% yields from treasuries, you can get 5% yields from savings accounts. That makes investors demand higher yields from income investments. Since yield and price have opposite relationships, they're inversely correlated, then you could say that that puts pressure on REIT prices. For the most part, underlying businesses are strong. Now there are certain areas of real estate that are not performing well, such as as office buildings. But the larger REITs that this is more heavily weighted to are generally performing very well. Top positions include things like American Tower, Crown Castle, Digital Realty Trust, Equinix, Prologis. Big REITs that are invested in property types that are largely doing pretty well. And personally, I own a lot of REITs. You probably heard me talk about them on videos if you follow my channel. But most of the REITs I own are relatively small. So this gives me exposure to a lot of the large cap REITs that I don't really want to own individually, but I do want some exposure to them. So I have been adding shares of the Vanguard Real Estate ETF to my portfolio. Number three, this is kind of an interesting one. The Invesco S&P 500 Equal Weight ETF. Ticker symbol is RSP, and the idea is the same as the S&P 500. 500 of the largest companies in the market, but just without the weighting. In recent years, to put it mildly, the S&P 500 has become very top heavy. Companies like Apple and Microsoft that are trading in the trillions of dollars are making up a disproportionate amount of the index. So I personally think the Magnificent Seven, as they're called, which are the seven largest companies in the market, could underperform significantly in 2024 and for the next few years. And recently, the equal weight S&P has underperformed just because those big top companies have done so well. But over the long run, the equal weight S&P 500 has actually outperformed the market. and by a pretty significant margin. So I like large cap stocks in general. Most of my investments are not in large caps, but I like large cap stocks as a long term investment vehicle. But the equal weight S&P kind of takes away the big exposure to any one company. If I wanted, 30% of my portfolio to be exposed to, just the top 5 companies of the market, I would just buy those companies. So this lets me truly invest in 500 large US companies, but not have to, have too much of my money dependent on any individual one. Number 4, the Schwab US Dividend Equity ETF. This is not a high yield dividend fund. If you look at some of those examples in the short description, Amgen, Broadcom, Home Depot, not the highest paying stocks in the market, but generally speaking, dividend stocks are rate sensitive, as I mentioned with the real estate. I think they could be big winners as rates fall. They were generally bigger losers as rates rose. So now could just be a great time to get some dividend exposure at a good yield on cost. Again, yield is about 3.5% on this ETF. And last but certainly not least, we have the Vanguard Extended Duration Treasury ETF. Ticker symbol is EDV, and as the name implies, it invests in long dated Treasury securities, specifically 20 and 30-year Treasury bonds. The average maturity is right around 25 years in this fund, so it splits its money pretty evenly between those. Yield is currently about 4.7%, which is historically pretty high for long duration Treasuries. So, right now, you're getting a great yield on cost, safe, predictable income, and these could rise significantly in value, or the market value of treasuries could rise significantly as rates fall. So it could be a really good time to get in on this ETF. I personally don't have, I don't want to say enough, but I don't have a lot of fixed income exposure in my own portfolio. Trying to change that a little bit this year, and this ETF I think is going to be one of the ways I do it. There are a few great ETFs for fixed income. There's the Total Bond Market ETF, which is BND, also a Vanguard product. But I think the extended duration fund makes a lot of sense right now, especially with rates expected to fall, because these, in terms of market value, are the most sensitive to falling rates. So hopefully you enjoyed that. I'd love to hear what you think, what your favorite ETFs are in 2024. Please let me know. I can't wait to hear your comments. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.